Dave Ramsey called it a load of manure. Suze Orman says it's a scam. But wealthy families have quietly used the infinite banking concept for over a century to finance businesses, buy real estate, and build dynastic wealth completely outside the banking system. So who's right? Is whole life insurance the worst investment in America? Or is it the ultimate wealth-building tool that the financial industry doesn't want you to know about? If you stay until the end of this video, you'll get a completely unbiased breakdown of the infinite banking concept. I'll show you exactly how it works on paper, walk through real-world examples, and then expose the hidden fees, commissions, and risks that the salespeople never mention. By the time we're done, you'll know whether IBC is a legitimate wealth strategy or an expensive trap, and most importantly, whether it's right for your specific situation. My name is your name, and today we're settling the biggest debate in personal finance. Before we dive in, a quick disclaimer. I'm not a life insurance agent, a financial advisor, or affiliated with any insurance company. I'm not here to sell you a policy or to bash the concept. I'm here to give you the facts, the math, and the nuance so you can make an informed decision. Now, let me start with the story. In the 1880s, the owner of a small cigar company needed money to expand his business. He went to the banks. They turned him down, so he did something unusual. He took out a loan against his whole life insurance policy. The strategy worked. He got the capital he needed, his business thrived, and that company, Fink Cigar Company, is still family-owned and operated today. That real-world example is what inspired Nelson Nash, a former life insurance agent, to develop what he called the infinite banking concept. In the 1980s, Nash wrote a book called Becoming Your Own Banker, and in it, he laid out a simple but radical idea. What if, instead of borrowing money from a bank and paying them interest, you could borrow money from yourself and pay yourself the interest instead? That's the core of the infinite banking concept. Here's the basic idea. You buy a specially designed, dividend-paying whole life insurance policy from a mutual insurance company. Instead of paying the minimum company, you overfund the policy by adding extra money that goes into a cash value account. Over time, that cash value grows, fueled by guaranteed returns from the insurance company plus dividends. Once you've built up enough cash value, typically after several years, you can take out a policy loan against that cash value. You can use that loan to buy a car, start a business, invest in real estate, pay for college, or cover an emergency. Then you repay the loan on your own schedule with interest. And here's the kicker. While you've borrowed the money, your cash value continues to grow as if you never took the loan out at all. Proponents of IBC argue that this creates a powerful, infinite loop. You deposit money into your policy. You borrow against it to make investments. Your investments make money. You repay the loan, which puts more money back into your policy. Your cash value keeps growing. Your death benefit keeps increasing. And you've captured the interest that would have gone to a bank, keeping it in your own financial ecosystem. They point to several key advantages. First, liquidity and control. Once your cash value is built up, you can access a policy loan at any time, for any reason, with no credit check, no approval from a bank, and no questions asked. The money is often available within a few days. Second, tax advantages. The cash value grows on a tax-deferred basis, and policy loans are not considered taxable income as long as the policy remains in force. Third, uninterrupted compound growth. Even while you have an outstanding loan against your policy, the full cash value, including the portion you've borrowed, continues to earn dividends and guaranteed interest. That means your money is effectively working for you in two places at once. Fourth, a permanent death benefit. Unlike term insurance, which expires after a set period, whole life insurance lasts your entire life. That death benefit is generally income tax-free to your beneficiaries. On paper, it sounds almost too good to be true, and for many people, that's exactly the problem. Critics, including personal finance heavyweights like Dave Ramsey, argue that the infinite banking concept is, at best, an overcomplicated mess, and at worst, an outright scam. Let me be very clear about where the critics are right. This is the truth most IBC promoters won't tell you. Critics point out that whole life insurance is one of the most expensive financial products on the planet. The agent's commission on a whole life policy can range from 50% to 100% of your first year's premium. That means if you pay $10,000 in premiums in year one, up to $10,000 of that could go straight to the agent, not to your cash value, not to your death benefit, to the agent's pocket. On top of that, there are annual fees and mortality charges that can range from 1% to 3% every year. In the early years of a whole life policy, often the first 5 to 10 years, the cash value grows very slowly. Why? Because the insurance company first deducts those massive upfront commissions and administrative costs. I've seen illustrations where someone pays $10,000 in premiums over 2 years and their cash surrender value is only $5,000. The other $5,000 simply vanished into fees. In fact, policyholders can lose the entire premium if they surrender in the first year. If you need to get your money out early, you'll pay surrender charges that can be substantial. Many policies take 10 to 15 years just to break even. Another major criticism is that the rate of return on whole life insurance is historically low. After all the fees and charges, the internal rate of return on a well-designed whole life policy is typically in the range of 2% to 4% annually. Compare that to the historical average return of the S&P 500, which is about 10%. Over 20 or 30 years, that difference is enormous. The same money invested in a simple low-cost index fund could grow to several times what it would become inside a whole life policy. This is the biggest argument against IBC, the opportunity cost of tying up your capital in a low-return asset. Critics also point out that when you borrow from yourself, you're not actually borrowing your own money. You're borrowing the insurance company's money, using your cash value as collateral, and you're paying interest on that loan. In many policies, that interest rate is not fixed. It can be variable, and in some cases, it can be quite high, ranging from 5% to 8% or more. Plus, there's a nasty tax trap lurking in the background. If your policy is not structured correctly, it can be classified by the IRS as a modified endowment contract, or MEC. Once that happens, all the tax advantages disappear. Your loans become taxable distributions, and you could be hit with penalties. This can also happen if you overfund the policy too quickly, because the IRS has strict rules about how much premium you can pay relative to the death benefit, known as the 7-pay test. Critics also argue that unless you have significant capital, enough to comfortably pay high premiums for many years, you'll never build enough cash value to make the strategy worthwhile. Whole life premiums are typically 20 to 30 times higher than term life premiums for the same death benefit. For most middle-class families, committing that much cash flow to an insurance policy is simply not feasible. There's also a darker side to the sales practices. Many agents who market the infinite banking concept are not trained financial advisors. They're insurance salespeople who earn massive commissions on these policies. In some cases, unscrupulous agents claim to be IBC experts but set up policies that work against their clients' best interests. Because the concept is complicated, consumers often can't tell the difference between a properly designed high cash value policy and a poorly designed one. This is not an accident. The complexity is the business model. Now, you might be more confused than ever. Half the experts say it's a scam. The other half say it's a miracle. So what's the real truth? The truth is that the infinite banking concept is neither a scam nor a miracle. It's a legitimate but highly specialized financial tool that works exceptionally well for a small slice of the population and is a terrible idea for everyone else. The middle ground is where reality lives. It can be a powerful strategy for high net worth individuals, business owners, and professionals who have already maxed out all their other tax-advantaged accounts, their 401n, Roth IRA, HSA. They're looking for another place to park capital that offers tax-deferred growth, a safe, non-correlated asset that doesn't crash with the stock market, and a source of liquidity for business or investment opportunities. For that small group, IBC can make a lot of sense. The guaranteed growth, the tax advantages, and the ability to access capital quickly and quietly can provide a real edge. But for the vast majority of people, if you haven't maxed out your Roth IRA, if you carry credit card debt, if you don't have a fully funded emergency fund, if you aren't already investing 15% to 20% of your income into low-cost index funds, the infinite banking concept is a dangerous distraction. It will tie up cash you can't afford to have locked up in a low-return asset, expose you to high fees and long surrender periods, and underperform the market significantly over time. Worse, it can give you a false sense of security. You think you've built a sophisticated banking system, but what you've really done is bought an expensive whole life insurance policy that you probably don't need. If you're considering IBC, here's my bottom line advice. Do not, I repeat, do not use the infinite banking concept as a substitute for traditional investing. Don't fund it instead of your 401n or Roth IRA. Those should always come first because they offer similar or better tax treatment with dramatically lower costs. If you have a high income, if you are already maximizing all those accounts, and if you have a specific need for a safe, liquid, tax-advantaged asset that can serve as a self-banking system for business or real estate investing, then you should consider the infinite banking concept. But even then, only work with an independent, fee-only insurance professional who has no conflict of interest, not a captive agent who works for one company and earns a massive commission from selling you a policy. Make sure the policy is specially designed to maximize early cash value, often by using paid-up additions. And be extremely careful not to trigger MEX status, which would destroy the tax benefits. But you don't have to choose one side of the debate. You can incorporate the best of both worlds by maintaining a simple, low-cost portfolio of index funds for your long-term growth while using a properly designed whole-life policy if it fits your specific situation as a volatility shield and a source of liquidity. Before I go, let me leave you with a simple decision tree to determine if IBC is right for you. First, have you maxed out your Roth IRA and 401? Second, do you have a fully funded emergency fund of 6 months of expenses? Third, are you free of high-interest credit card debt? If the answer to any of these is no, focus on that first. IBC is not for you right now. If the answer to all three is yes, then ask yourself, do you have a specific need for a safe, liquid asset that you can borrow against for business, real estate, or other investments, an asset that won't lose value when the stock market crashes? If not, skip it. If yes, then and only then start researching high cash value whole life policies from top-rated mutual companies with a track record of paying dividends for over 100 years. Now, here's your actionable step if you're still curious. Do not buy a policy from the first agent you talk to. Ask every agent for an instant force illustration showing the guaranteed cash value, not the projected dividend scenario for years 1 through 20. Ask them to show you the total fees, the surrender charges, and the timeline to break even. Take those numbers and compare them to what you would have if you simply bought a 20-year term life policy for a fraction of the cost and invested the difference in a low-cost index fund. Run the numbers yourself. Be skeptical. If this video gave you a clearer picture of one of the most controversial topics in finance, hit the like button. It helps others find a balanced perspective. Subscribe and turn on notifications. In the next video, I'm going to teach you how to use dollar cost averaging to sleep well at night, even in a crash. You won't want to miss that one. The infinite banking concept is not magic, it's math. And the math says that for most people, the costs outweigh the benefits. But for a select few, it can be a powerful tool in a diversified financial plan. Now you know how to decide which camp you're in. I'll see you in the next video.